Hello everyone, welcome back to my channel. And in today's video, I have a very interesting topic for you, right? And the topic is Basel Accords. You can also call them Basel norms. See, what Basel norms actually are, they are basically the rule book behind the global banking. What its primary purpose is to make sure that the bank knows and is able to make a well educated guess or a decision on how much risk they can take. So it answers a primary question that how much risks are banks allowed to take. But doesn't this sound a little bit different? See, we haven't heard about a rule book for investors or maybe companies. They are also investing their money, right? They are also taking on risk. But we have never come across any rule book for those investors and companies. So why the bank, right? So the problem is that banks are quite different from normal companies. I've discussed about how they are different in my previous video when we talked about the COCO bonds or contingency convertible bonds, right? We've talked about how they're different from the normal companies and why? Because when banks actually fail, they send a ripple effect across the economies. And what are the ripple effects? What happens is the payment freezes, the credit freezes, there are job losses, and eventually, who has to suffer? The taxpayer. How? Because whatever money he gave for taxes, right, which was ultimately should be used for infra development or his social security benefits, what actually is happening? It is going back to the bank in form of government bailouts, right? And why we have to limit on how much bank should take over a risk is because of a global challenge as well. See, we know that there are countries who are under a lax jurisdiction, right? What is lax jurisdiction is basically some countries often provide things like a tax haven, right? So doing business in one particular country is much more easier than another country, or maybe getting your company registered in one particular company and having their main operation in another country makes sense. Right. So basically, what can happen in that particular situation is risky banks they attract capital in that particular jurisdiction because the regulations are quite low. And a rule of one nation cannot be applied to another nation. Right. They all have their own set of rules. Right. So we needed a global coordination for that manner because we know that bank failures is not a random or some simple economic event. Right. And when we're talking about modern banking, what happens is, see, modern banking runs on confidence, right? Depositors, business, and the markets must believe in bank in order to make sure that the economy is actually creating money. And how would they do that if they believe that the banks could actually survive the losses, right? Now, imagine let's walk through an example, right? So let's say I have 100 rupees in my hand. I have my 100 rupees in my hand and I walk into a casino, right? Let's say we talk about 10% of my money, right? 10% would be 10 rupees. Let's say I am betting 10 rupees. You would say yes, you're doing a reasonable bet, right? If even if you lose 10 rupees, you don't lose much and it's a safe bet. I might be a smart guy for you, right? The problem is the upside is small and the best part is the downside is limited, right? So this invokes a feeling of being safe, right? But the problem is even if I see I'm putting in 10 rupees, even if I grow this particular capital by 20%, it will ultimately become 12 rupees. So ultimately I gain rupees 2 and that's 20% for 10 rupees. But what was my initial deposit or maybe the amount of money that I brought in? That was 100 rupees, right? That was 100 rupees. In comparison to 100 rupees, the return is only 2 rupees. That is 2%. Although we were very conservative about it, we didn't take in much risk so as to our reward was quite low as well. Right. But when we're talking about, let's say I am putting in 50 rupees, 50% of my capital that I brought in, good returns are ultimately possible, right? But I'll always be scared, right? There'll always be a feeling in my heart that that the money that I just put in could absolutely evaporate, right? I could see nothing out of it. And if I turn everything in, what will happen? You would genuinely wish that I had a supervisor on my head, right? No one could sleep in that particular situation when everything, your entire capital is at stake, right? It is the biggest possible disaster that could happen to you, right? You are so close to that. So the problem with banks is much more exponential. See, it was my 100 rupees. All and everything would be borne by me, myself, and no one else. Right. But the problem with banks is they are actually using depositors' money. Every penny that they have are coming from depositors. Right or not? Right. They don't have their own capital. That deposit money is ultimately your savings, your salaries, and your pension. So basically, your past, your present, and your future. Everything at risk all at once. Let's say your bank is gambling 100% capital on a casino. Would you sleep at night? Everything that you work for, your past, your future, everything online, right? Banks are very much connected to the economy because at the ground level, see what is happening. The house that you live in are backed by mortgages, which comes from bank. The business, right? The business that you might start of your own are basically funded by banks in form of debts, right? It is helping in trade, or maybe the shop that you just got your chips from, right? That whole business could actually survive with the help of the debt that bank eventually gave, right? So when basically they become flatter, credit eventually stops and jobs tends to disappear, right? And the problem or the reality with the bank is they're actually too big to fail, and that's why. See why? Because they are so much deep rooted into the economy, and they are actually using the depositors' money. So it is so interconnected within the economy that government has to step in with the bailouts, which are eventually the taxpayers' money only, right? Because it is so much important, and ultimately taxpayer have to bear the cost of poor risk decision, right? Now, see, let's bring it back. Why they are different? See, what is happening is when we're talking about a restaurant failing, what is happening? Try to understand this. When the restaurant is failing, who are having a loss? The owners, the employees, the suppliers, the customers, right? What are these? These are the stakeholders that are associated with that particular business only. Even the local economy barely would notice that a restaurant is gone. Why? Why is that the scenario? See, what is happening is if a restaurant closed down tomorrow on the same place with the same employees or maybe the same suppliers and the same customer, another restaurant with another name would be opened there and people would start visiting there. No one will actually realize anything happened, right? Except maybe a few color theme changes and a taste change. Right. But when an entire bank is falling, what is happening? Depositors are basically losing access to their money, that too, past, present, and future. Businesses, maybe some businesses have a nature of getting cash flows at maybe one time of a year, right? For the rest of the years, maybe they are just reliant on bank providing them with debt so that they can cover their payroll. Right. The payment system of the entire bank and the economy can fail. And panic, in any crisis, if anything big fails, panic spreads like nothing else. Right. And across the economy, the credit starts to contract, and which ultimately makes the government forced to intervene. Right. Now, this is very important. Right. Banks are actually creating something that companies don't. Right. Now, this is very important at this particular time that you understand exactly what systematic and unsystematic risk is. See, when we are talking about a systematic risk, right? What systematic risk is, systematic risk would affect entire market, right? Each and every industry, each and every stock would be affected. How? It happens because of maybe wars. It could happen like pandemics, right? Systematic risk happens when the entire economy or the entire market is struggling. But when we are talking about unsystematic risk, what brings in unsystematic risk is, let's say, a CEO of a company could be caught for manipulating the books, right? Now, that effect would be tolerated by that one company only, unlike unsystematic risk. When there is a war, when there is pandemic, the entire market is struggling. But due to unsystematic risk, only that particular associated company would eventually struggle. Right? Is that clear? So this unsystematic risk is something that you can diversify. Right? You can easily diversify it. How? See, rather than investing in just one company, you can invest in two companies. So if the CEO of one company is caught manipulating the books, the other CEO is not, relevant that the other CEO would be doing the same. So this particular company would totally be unaffected by whatever the first company did. Right. So banks are basically what are doing. See, companies could create a unsystematic risk for that particular company itself, but that's not the same scenario with the banks. Right. Banks are known to create systematic risk. Right. And now let's talk about a very important concept, that is capital cushions. See, what is capital cushions? It is basically whatever assets that you have, you should have a cushion for that. Cushion for what? For absorbing losses. See, value of assets, the markets are pretty volatile, right? You should have as much loss absorbing assets on your balance sheet to make sure that the deposits, which are ultimately considered safe havens, right? At least for making sure that your capital is preserved, right? So you should make sure that you have relevant amount of cushions, right? Now, when we're talking about restaurant, what is happening? Let's say the restaurant have an asset of 100 rupees. That could be 90 rupees, but we have a good amount of equity which act as cushion. Now, how it acts like cushion is because whenever there is a loss, this equity shareholders are the one to bear it the first, right? So they bear it first. Whatever discrepancy or maybe market volatility hits, it hits the equity shareholders first. After the equity have lost everything, then it comes back to maybe the senior debt, right? That too at the last, right? But what happens in typical bank is that assets are 100, debt is 95, and the equity cushion is only of 5%. And this creates a very dangerous situation, right? Now, we have to understand where the birth of Basel came from, right? So basically, what was happening was, when we're talking about, let's say, country A, and in that particular country, high risk is allowed. So what happens? Banks eventually take bigger bets, they get higher profit. When they are getting higher profit, they are attracting investors and capital from around the world, right? Because everyone wants to invest in something that is giving them higher returns. Investors are continuously looking for higher yield, right? But when we're talking about country B, what is happening is, in country B there are strict safety rules. Banks are much more stable, and the cost and the returns are quite low. So capital flows to the riskier jurisdiction instead, right? But what happens? It creates a chain reaction. When there is more risk, you get higher returns. When you get higher returns, see, this country A has a competitive advantage over this. This country B is having competitive pressure. Right. So basically, what happens in a downtown, in a downward rally, what happens is the funds start flowing to country A, and everybody starts playing with their rule books, right? Making sure that they can exploit any loopholes that exist. So what happens? Everybody starts following the topper until he decides to jump off the terrace, right? Which ultimately leads to a very dangerous situation, right? The answer that Basel norms introduced and what everyone needed was a common rule. See, banks were operating across borders, right? And different nations had their different set of rules. So there existed arbitrage and instability. What Basel Committee, which was formed in Basel in Switzerland in 1974, basically what they did, it was formed by the central bank governors, and they first introduced Basel I in 1988. Right. What it actually did, it prevented bank in strict countries from being disadvantaged by the companies in lax jurisdiction. Right. So they were helping the countries who are having strict rules, right? Because capital was flowing out of those countries and it was going to the competitors in lax jurisdiction, right? So again, let's understand the importance of the capital cushion here, right? See, when you are buying a house with 20% down payment, right? Basically, what you do is you put 20 lakh of your own money. Bank would eventually lend you 80 lakhs. If the price of the house drops 10%, see the price of the house is 1 crore, right? It's 1 CR. If it loses its value of 10%, it becomes rupees 90 lakh. But the bank gave you a loan of 80 lakhs, so it is still protected. It's still holding 90 lakhs of asset, right? So you basically survive. But what happens if the down payment was only 5%? You put in 5%, the bank lends 95, and there's a 10% drop. Now the asset itself is worth 90 lakh rupees. This is the problem with thin cushion, right? So bank capital is nothing else but your down payment, right? And this is what was the most important concept that we have to learn. It is basically a shock absorber that is keeping banks and the economies alive. Now, how capital is actually protects a bank during the loss. See what is happening is, let's say the bank is holding 100 crores in asset and it is funded by the deposit of 90 crores, right? Sorry. So the capital of 10 crore, which is 10%, is absolutely healthy, right? Let's say there is a loss of 6 crores, right? Now what is happening is, six of a loss of 6 crores means assets are now worth 94 crores. Deposit still remains the same. But now, because the capital was 10 CR, which was 10%, it was healthy, the capital still is 4 crores. Right. So we still have a cushion left, even after a 6% or a 6 crore loss. Right. So the capital basically absorbed the loss, and the depositors were safe, which was our primary goal. And because the depositors were safe, the banks eventually survives. If the capital was only 5 crores, let's say the situation was 100 crores of assets, deposit were 95, and the capital was 5 CR, and there was 6 crore loss. So it eventually leads to negative equity. So banks become insolvent and depositors and system is at risk. Right. So what came into picture was the concept of risk weighted assets. Right. Now we have to understand about risk weighted assets. See, what Basel actually told you, this was actually Basel 2, right? So their ideology was that the government bond cannot be treated the same as the startup loan. There are lot and lots of risk that is associated with startup loan, which is not the case with government loan. So they allocated risk weights to each asset. For cash and central bank reserves, it was 0%. That is risk weighted average, right? For government bonds, it was 20%. For residential mortgages, it was 50%, and for corporate loans, it was 100%. Now, how it actually works, let's go to the maths. Let's say you you want 100 crores in government bonds. The risk weight is 20%, right? 20%. Now, risk weighted assets are of 20 crores. This is how you get that particular number. Now, what capital required here is basically capital adequacy ratio, right? Let's say it is at 8%. So, what your initial capital should be is 1.6 crores, right? So, for government bond, this is the question, this is the equity, right? This is a safe question when we're talking about assets, right? But when we're talking about corporate loans, the risk weight was 100, right? Now, the risk weighted assets would be of 100 crores, that is the entire capital, right? So, with 8% CAR, capital adequacy ratio, with 8%, you need a cushion of 8 crores, which makes sense keeping in mind how much risky the capital bonds actually are, right? So this is basically the capital ratio formula. So we have the capital, we divided by the risk weighted assets, right? So the risk weighted average was 100 crore in case of corporate bonds, and we have a 10 crore capital, let's say for example, and the capital ratio becomes 100%, right? And regulators basically set the minimums. They basically tend to be like 8% plus the buffers, and if the value falls before this, it triggers restriction, capital raises, and resolution. It's something like the margin call, right? It's a if there is a higher ratio, like we have observed in the case of corporate loans. It was 8% approximately. So you get more room to absorb losses before depositors or taxpayers are at risk. Right. Then we have the risk adjusted measure. The bank with risky assets need more capital than the one with safe assets. Are you now trying to understand how it solved the problem? See, mm, we talked about with in lax jurisdiction, banks were taking on more risk and more riskier assets. Right. So if you are investing in riskier assets, you need much more in capital adequacy ratio, right? The percentage of CAR is much more higher, and this is providing leverage to companies or maybe banks who are investing capitals in less risky instruments, right? So let's talk about the entire Basel norms, right? So in Basel one, which came in 1988, the basic principle of it was to make sure that there are simple capital rules that are followed throughout the jurisdictions and across the globe. Right. So the problem with that was it was too crude. It was the first one, right? So basically, it treated all loans the same, right? So corporate bonds came under the same heading as cash, right? Or the government bonds. So with Basel 1, we realized that there is a risk sensitivity that is needed, right? So then came the Basel 2 norms, which was more of a risk-based approach. So now the problem was that the bank's own model could ultimately underestimate the risk. So with that, we realized the model needed an oversight, which ultimately led to the birth of Basel 3 norms, which basically focused on resilience and liquidity. But the problem is actually it Basel 3 is still evolving, right? It is taking and absorbing all the facts and probabilities from the 2008 and the Silicon Valley Bank collapse. and it is working on more capital plus liquidity rules. So the lesson was capital alone isn't enough, right? You will understand it more. So in theory, what happens is what we are saying is if we have more capital, we have safer banks. There would be fewer crises and the trust would be increased and the growth would be stable. But in reality, what basically happens is if you are asking for too much capital or too much equity, what is happening is I can't assume that too much capital, right? It's not the same if the CAR is 2% or if the CAR is 8%, right? So, if I can't afford the capital requirement, I would lend less, right? So the growth eventually becomes slower. But if the CAR is too little, the crisis would still happen and the model will eventually fail, right? If the lending is, see, ultimately the purpose is defeated in this particular situation, right? Now, we need a balancing act and not a pure act. See, when we have the 40% capital requirement, which makes the bank extremely safe, we have low returns. As simple as that. Lending is basically is bound to shrink dramatically and the economy would suffer. But with the 2% capital requirement, what happens is bank would have high profits. Why? Because it would be undertaking high risks, right? It would create ultimately a fragile system and the next crisis would be knocking at your door in just a matter of time. What happened in Silicon Valley Bank was basically even the strong capital weren't able to save them because the strong capital is never equal to liquidity. SVP, Silicon Valley Bank, obviously had solid capital ratios, but they were actually held in long duration bonds. So when eventually the rates rose, the unrealized losses, right, it basically mounted and there was a bank run. And it bank run obviously, whenever you hear the word bank run, it obviously tends to make everything worse. Right. So what happened was the regulatory focus was heavily focused towards the credit risk, and the effect of interest rate and the liquidity risk was somewhat undermanaged in the particular framework. Right. Plus, the particular case with Silicon Valley Bank was the risk of concentration. What happened? They were quite relied on the unsecured tech deposit, right, which created a fast moving run when confidence cracked and basically the liquidity spiral made its gain. So what happened was rules actually reduced the risk, but it failed to eliminate it, right? And because of that, even the well capitalized bank failed, right? Because there was liquidity risk that existed in the same environment, there was a concentration risk that existed in the same environment, and they were ignored, right? So when we're talking about how to limits of rules, right? Rules can obviously reduce risk, but they can not eliminate the uncertainty, right? Because when we're talking about the bad risk model, the historical data, when you're looking at historical data, it is only telling you about all the things that have already happened. Every day a new crisis could come into picture because of something that has never happened in the past. So all the data we have is just because something in the past have went wrong, right? So this basically creates a very bad model, right? We obviously have the regulatory arbitrage, right? Banks always are in uh, hunger or thirst of getting more returns, right? So basically what they try to is find loopholes and find their way around the rules. And see, when we're talking about the environment, it is quite volatile, right? Given any situation, given any rules or regulation that is guarding them, black swans events can eventually happen, right? The ultimate plot of black swan events is that they are unexpected circumstances. So it can actually happen anytime, right? You can get liquidity shocks, right? Capital rules are not guaranteeing cash, right? It is making sure that you have enough capital, right? You have enough skin in the game, right? Then we have the political pressures, right? The regulators itself can be influenced or they could be slow. Then we have the coordination failures. See, we are imagining that particular set of rules are applicable throughout the globe, and it is a very difficult thing to do, right? So, who actually decides how much risk bank can take is basically how much banks want returns, which is basically tells you about the risk in the system. Then we have the society's answer, which comes through the capital rules. right? Then we need international coordination, which was brought in by the Basel standards. Then we also need a strong local environment, right? And then comes the bank's actual behavior, right? So see, Basel Accords are not really about compliance, right? If you're not following Basel norms, no one is gonna come knock at your door and arrest you. Why they exist in the first place is because they are basically creating a benchmark. Let's say a bank in India is not following the Basel Accords. What will happen? No one is going to arrest them. But we can forget about foreign investors because foreign investors know that every bank around the globe is following business norms, but this particular bank is not. So it is not under the benchmarks, the first footstep of someone choosing the bank. So it can officially stop thinking about any foreign investors, right? Because they have capital and they have opportunities as well, right? So all they need is trust. Right, and this Basel Accords basically come into picture when the trust loses. Right, so the trust is in reference to if the banks can actually survive losses or not. Right, can the depositor access their money anytime that they want? Right, the trust comes from then the credit keeps flowing into the real economy, right? And of course modern banking runs on confidence and Basel exists to protect it. It is not a cell, it's not something. If you not follow it, it will just someone would come and arrest you, right? It is just setting a benchmark, right? So every bank is different. Thin capital but systematic risk means the bank failures are everyone's problem. Capital is a shock absorber. It is basically the cushion that protects the depositors and economy when the losses actually hit. When risk is greater than the size, Basel cares more about how risky the assets are and how big the balance sheet looks. It's basically a balancing act. If too much capital stifles the growth, too little invites the crisis, and the sweet spot is debated forever. Rules basically evolve. Every version of Basel was a response to the failure of the previous one. We've actually heard about it, right? How? See, risk sensitivity needed. So it was a risk-based approach. Models needed oversight. So it was focusing on resilience and liquidity, right? The trust is the real goal. Basel isn't just bureaucracy, right? It's the society's attempt to keep the confidence in the banking system, right? So this was all about the Basel Accord and norms. And if you have any doubts related to any part of this video, please feel free to comment down in the video, and I'll definitely make sure that I reply to each and every comments. Thank